Hello traders, and welcome back to the Forex Geek, where we dive deep into the tools that can help you make smarter trading decisions. So in today's video, we're going to be talking about the bullish side-by-side white lines pattern, and this is a powerful continuation signal that can enhance your trading strategy. This pattern, while not commonly seen, offers high reliability when it does appear, making it a valuable addition to your trading toolkit. Stick around to the end of this video to learn how to identify this pattern and effectively incorporate it into your trading plan for potentially profitable results. So without wasting your time, let's get started. So let's start with the pattern breakdown. The bullish side-by-side white lines pattern is a 3-candle formation that signals a continuation of an uptrend. Understanding its structure is key to recognizing this pattern in the market. So what are the structure components? We have the first candle, which is a strong bullish candle that confirms the ongoing uptrend. This is the first candle. And then we have the second candle, and it opens with a gap up from the close of the first candle, indicating continued bullish sentiment. There should be a gap between the first and the second candle. The first candle's close and the second candle's open. There should be a small gap. It could be big actually, but there should be a gap actually. So then we have the third candle, and the third candle opens and closes at similar levels as the second candle, reinforcing the bullish momentum. So what are the key recognition points of this pattern, the bullish side-by-side white lines pattern? So to effectively identify this pattern, you need to look for specific characteristics. The pattern must occur during an established uptrend to signal continuation. A gap between the first and second candle is crucial as it shows increased buying pressure. And lastly, the second and third candles should have nearly identical opening and closing prices, highlighting market stability. So let's hop on the charts and try to spot this pattern. We have two examples here, and this is a bullish trend starting. We have this price reacting off of the first thing is to look at the market context. In this case, we have a key level right here. So market is reacting off of this key level, and it has started giving us this bullish push to the upside. And then we have this first candle here of our bullish side-by-side white lines candlestick pattern. In this case, you could call them green lines because the colors for green bars, the bullish bars, are green on my chart. So this we have is the first candle showing strong bullish ongoing trend, and the second candle is this, opening with a gap between the first candle's close and the second candle's open. So this gap signifies continued bullish sentiment. And then we have the third candle with similar opening and closing prices, and also within the second candle's range, showing stability, bullish stability, reinforcing bullish momentum. So as you spot this pattern, you should be looking to enter buy trades to continue the uptrend, the ongoing uptrend. Remember, this is an uptrend and we're looking to push prices higher. Why? Because price is reacting off of this level right here. Same thing happened here, and then we'll have the first candle, which is this bullish candle right here, and let me use the arrow to mark this out. This is the first candle, is the bullish candle, and then we have the next two candles having nearly identical opening and closing prices, and we also have the gap. This shows that this is a valid bullish side-by-side white lines candlestick pattern, and we should be looking for buying opportunities after spotting this pattern. So let's talk about how you can enter, the entry points, how you can use this candlestick pattern to trade. And to capitalize on this pattern, consider entering a long position once the third candle completes. This completion confirms the pattern and suggests a continuation of the uptrend. Ensure that the overall market conditions support your decision by checking for additional confirmation signals such as increased trading volume. So I'm just going to add the volume. So first you should have your volume indicator present, and this will help us validate increasing buying volume, and this will help us validate our trades. So you should enter at the close of the third candle. Once market has shown that it has stabilized and the bullish momentum is here to stay, we should be looking to enter a buy trade. For example, in this example, this scenario, this is the first candle, this is the second, and this is the third candle. At the close of the third candle, we should be looking to buy. But first, before we buy, before you click that button, you should also confirm the rising buying volume. You can see more of buying volume here than we have selling volume bars. The volume bars, we have more of bullish bars than bearish bars. You see more of increasing green bars than we have bearish red bars. So this shows that buyers are stepping into the market. At the same time, when we have this bullish side by side white lines, and this is a valid confirmation, you should always use the volume analysis to confirm your trades. Also, you should also confirm your trades with additional market context and price action. For example, this is a valid support level, and we are reacting off of this support level, and we are looking to push price to the upside to break for structure. So your stop loss should be below the low of the first candle, and this placement protects your position in case the market reverses unexpectedly. So here your stop loss should just be below the first candle, the low of the first candle. And for your target, set a realistic target by aiming for a minimum of 1:2 risk to reward ratio. This approach ensures that your potential gains outweighs the risk involved. So additionally, consider using trailing stops to lock in gains as the trend continues, allowing you to maximize your returns while minimizing risk. Also, you should try validating your setups using additional indicators like your moving averages or your RSI. So I'm just going to try adding the moving average to help us also validate this candlestick pattern. So this is important as it helps us filter false signals and false buy opportunities. So I'm just gonna try to add the moving average to our charts. Okay. Okay. And let's look at the second example. This is the second example right here, and look, if we're looking to buy from here, we should be entering at the close of the third candle, and with stop losses just below the low of the first candle. And your take profit should be at 1:1 or 1:2, 1:2 risk to reward ratio, or you could just target oh sorry, I had a problem adding my moving average to the chart, so I'm just gonna move forward. And you could target significant resistance levels. Basically, using the moving average is just waiting for cross. Moving average crosses the dead cross. When the 20 period moving average crosses above the 50 period moving average, it signifies a buying opportunity in the market, and you can use this to validate your trades. You can use it to validate your buy trades when using the bullish side by side candlestick pattern. So traders, you've come to the end of today's video. Engage with us in the comments below. We want to hear about your experiences. If you found this video helpful, don't forget to like, subscribe, and turn on the notification bell so you never miss out on more trading tips and strategies. Thanks for watching, and I'll see you in the next video.